I'm sitting on a plane somewhere over Oregon. I'm anxious and restless. I'm anxious because right before I got on the plane in Seattle, I read an article headline about how the market will start climbing back up any minute now. And I'm restless because I'm still 3 hours away from landing at LAX, and I need to get home as soon as possible to put in more buy orders before my favorite index fund gets more expensive. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, a channel dedicated to helping the Sands generation master money and achieve financial security. Market timing is the obsession in the world of investing. It's nearly impossible to pick up a financial magazine without seeing headlines telling us which way the market is headed. You turn on the news and every so-called expert talking heads are talking about what stocks are projected to go up and which ones are on its way down. And the internet is full of steady stream of advertisements from financial newsletter writers promising fantastic returns if you'll only subscribe to their fee-only newsletters and their market timing advice. And there are just as many people shouting the opposite. They say that market timing is futile. One would be stupid to try to time when to enter and exit the market. Predicting which way the market will head next is really a fool's errand. So with so much energy being spent on this idea of market timing, who is right? Can you really time the market, or is it really a fool's errand? In this video, we're going to get to the bottom of market timing. We'll see if market timing really is a fool's errand, or are there opportunities to make money here. The basis of market timing is to know when the market or a stock is low so you can snap them up cheaply. And then you can identify when the market or a stock is high so you can sell your cheap stocks for a hefty profit. And with the outset of COVID-19 pandemic, war in Ukraine, and in general economic uncertainty, the trading activity has just increased with historic levels of volatility. Individual investors, day traders, and even hedge funds are jumping in and out of the market trying to bank on this increased volatility. But the key to winning here is getting the right, accurate information about the market, right? Good information will tell us what's happening to the market right now and where it will go in the near future. So where can we get this accurate information? Let's check out a few options, starting with the financial news headlines. But unfortunately, this might not be a great place to get good information. Most often, market experts can't even agree with each other on how the market is trending or where it will go in the near future. There are articles published on the same day by different experts who completely contradict each other. The quarterly earnings will be ugly. Actually, no, the quarterly earnings won't be so bad. Who do you listen to when you're trying to time your buy and sell? Major news outlets can't even agree upon the economic impact of the Ukraine war in Russia. If you get your trading information from the financial news headlines, you'll be driving yourself crazy because you'll browse through multiple contradicting information. Alright, if headline news is not a good source, maybe how about the financial TV shows? Jim Cramer, the host of CNBC's Mad Money, is famous for his flamboyant personality where he doesn't just talk about stocks, he shouts them. He intersperses his show with guest interviews and calls from real live viewers. But unfortunately, when we dig into shows like this, it's easy to see how they're Wall Street's marketing machine in action. These type of shows are filled with commercials promising that if we use their advertised products or services, we can easily outperform the market with accurate information. We can dance in when the market is low and dance right out with a fat check when the market is high. What you'll notice in these shows is that financial experts who appear in these shows are one of the most confident people you'll ever run into your life. They know exactly where the market is headed, what the interest rate is going to do, and where to invest our money now. You'll never hear them say, I don't know. As soon as the program is over, viewers rush to their computers to start acting on these expert advice, unaware that what sounds so convincing is often cleverly disguised marketing pitch for the product or service recommended. Wharton School at UPenn actually conducted a study that compared Jim Cramer's stock picks against the S&P 500 over a 17-year period. And the data showed that S&P beat Cramer's portfolio by a whopping 3%, 7% versus 4%. Financial TV shows are like any other TV shows. They aren't there to provide accurate information, they're there to gain viewers. And sensational stock predictions sell ratings. The accuracy of these predictions doesn't matter. Alright, so financial TV shows aren't a great source of accurate information for market timing either. So how about some of these famous money magazines and their websites? We see these magazines in all the bookstores, airports, and supermarkets. And their websites seem to have some great information about money. Unfortunately, articles and columns most beneficial to investors are oftentimes found tucked away deep within hidden parts of the magazine or website. They rarely make the homepage or the front cover. The homepage and cover spaces are reserved for attention-grabbing headlines that bring new audiences. All major financial magazines and websites adorn their homepage with headlines about the best stocks or funds you must own now, prophecy about the future of the stock market, and other sensational attention-grabbing titles. And most damaging to the individual investor is that numerous studies back-testing the investment recommendation of cover articles reveal that most badly underperform the market. But these businesses can't stay profitable without attracting a crowd, so they must play the attention game, no matter how inaccurate they might be. Can you imagine the headlines being filled with rational, pro-index, slow investing stories? The magazines won't be able to sell anything. Nobody will visit their websites, and they'll go out of business. So the reality is that as long as there is financial media, we'll continue to see these enticing but worthless 6 stocks to buy now headlines. So if we can't trust the financial media and the websites, what do? I'm sorry to be the bearer of bad news, but if you thought you could make a killing by timing the market, I have to tell you, it really is a fool's errand. And don't feel bad if you have done it. Not many of us can honestly say we haven't done it ourselves. I do it constantly, and my wife has to slap sense into me quite often. The Motley Fools, who interestingly is one of those big financial websites, actually define market timing pretty accurately for us. They define market timing as a strategy based on predicting short-term price change in securities, which is virtually impossible to do. While I don't agree with all their articles and contents, they nailed this one on the head. It's a futile exercise to pick winning stocks or funds because no one knows accurately where a certain stock or the market as a whole will go. Everyone has an opinion. But it is just that, an opinion, not an accurate prediction. Unfortunately, this fact does not stop thousands and millions of investors from trying. The logical alternative to market timing and performance chasing is to invest in a low-cost index fund, setting up a long-term asset allocation plan, and staying the course. When we see the market going up and down, and we see friends and family making supposedly millions from their hot stocks, staying the course is hard. Who doesn't want a piece of the action? But have confidence in your plan. Low-cost index fund and appropriate asset allocation strategy will work if we simply have patience and give it enough time by staying the course. Wall Street can't promote buy and hold strategies because brokers need trading activities to make money for their firms. For this reason, when you turn on any financial news, expect the sensational headlines and seductive money-making potential. Or better yet, don't turn it on at all. That'll save you a lot of brain space and give you a peace of mind that you aren't being manipulated for someone else's benefit. Wall Street and financial media have a symbiotic relationship. The media wants readers, viewers, and listeners, and most importantly, Wall Street advertising dollars. Wall Street also wants readers, viewers, and listeners, but most of all, they want your dollars. With the help of these powerful media companies, Wall Street has been very successful at getting investors to chase after last year's winning fund and market time. And since purchases and sales can now be made with the push of a button, it's hard for so many investors to resist the urge to trade more frequently than ever before. They think they're buying low and selling high. But sadly, most often they're buying high and selling low. We think most trading activities follow sound logic, but most often they're based on high emotions driven by financial media. Market timing is futile effort. When it comes to investing, heed the advice of Warren Buffett. Inactivity strikes us as intelligent behavior. Less activity, ironically, is better when it comes to investing in the stock market. And in the spirit of buying boring funds for your long-term investment strategy, check out my video on 5 best Vanguard index funds to buy and hold forever here. And if you found value from this video, I would appreciate it if you could hit the like button. It really helps with the YouTube algorithm and allows videos like this to be shared with more people. Thank you guys for watching, and I'll see you in the next one.